Our first speaker is Darren from Devonshire Corporate Finance. You're going to talk about raising finance for fintech startups.
Good evening. For those of you that don't know Devonshire Corporate Finance, we're the FSA regulated corporate finance arm of Kingston Smith. So I'm one of the directors at Devonshire. I'm here with one of my colleagues, Marcus. Just going to take you very briefly through some of the key points to consider when raising funds for tech startups. Not necessarily just a list of where you might go, but some of the issues you might encounter and some specific stuff actually for the tech industry. The first port of call, I guess, is an area that gets missed quite a lot, which is the funding strategy. Often, somebody has a great idea for a product and they launch straight into, right, who can I get to actually put money into the project? Well, they sort of miss the point, which is that without a strategy, the funding strategy would essentially drive where you should go to get your money. Some of the considerations just on the slide, maximise equity. Sometimes people have a strategy where they want to keep a certain amount of equity. Often that amount of equity is control, and that will therefore dictate where they go to. So they may avoid some investors where they know they won't be able to keep control. And then if they're looking to maximise their equity, then potentially you may need to think about other things such as how much you can put in personally, because our experience of funders is that they don't like putting in a couple of million quid into something where the founder's putting in no equity at all, and then they're expected to take a minority stake. So you need to think about that when you're devising your strategy. Other things to think about: testing the market versus a major marketing campaign. This is sort of almost how you would launch the product, and it obviously drives the funding. And there's some commercial considerations around both. Which is that obviously test the market is less risky, in the sense that you can test the market, see how it goes, and obviously the big thing is you can iron out any glitches that are there before you then approach the mass market. But some products need a major marketing campaign. We'll go on to IP a bit later, but there are certain products where patenting is difficult, and therefore your protection essentially is around first mover advantage, and so therefore a major marketing campaign may therefore be the way to go, and that will maybe not affect who you approach from the funding point of view, but it may affect how much you raise. And then a strategic alliance is important as an option, and it's one, in my experience, that gets overlooked the most, in that most people think that they need to go to actual financiers, whereas actually the right funding strategy for certain companies can be a strategic alliance with a company in the sector. There's a couple of other advantages other than just getting the money that you want, in that they can provide an infrastructure for your product. They can replace a skill set that you may not have. For example, a lot of tech startups have the technology and the technical background, but where they're weak is on the marketing and the commercialisation side of things. So you can actually kill two birds with one stone, particularly if the company's big enough that they can provide the funding as well. So the funding strategy as a whole is a piece that I see gets missed out quite a lot, that's really important. I'll just let Marcus talk you through some of the actual options for funding.
Hello. Right, as we're talking about startups, with the first two, banks and private equity aren't strictly relevant to startups, so it's a question of kind of whizzing over them. They'll tend to invest in established businesses. As we all know, banks at the moment aren't tending to do a great deal at all, even in that space. Moving on to VCT and VC, that's more the end that's going to be interested in startup. They're interested in companies that are fast, that are growing quickly, normally high risk, where there's high potential. They'll be looking to exit in maybe 3 years or so, maybe take a stake. Some of them might get operationally involved as well. Government grants is quite a specific area. There are broadly three types. There's up to 25k you can claim, up to 100k, and between 100k to 250k. We tend to work with others that specialise in this space. There's a company called Grantry, for example. The basic way that it works is they will you put in the money and they then give you back about 60%, and they keep track of what you're up to on I think it's a quarterly basis, and then they give you the money back providing you're still complying with the rules. Because I'm sure you're all aware that there are various angel networks out there, both on a local level and on a national level. So there's the British Business Angels Association, of which one of our partners is a director. There's the Angel Investment Network. There's Angels Den, which I'm sure you're all familiar with online, which says they have 4,000 angels all looking to make investments. The size of investment is around about the 50k to sort of a couple of 100k, and so again slightly smaller than the VCT, which goes up to about $1 million, and VC can be $1 million plus. Friends and family, well again, and that's pretty obvious, isn't it? It's going to be one of your first ports of call. It's going to be one of the cheaper sources of finance, obviously. And then Darren's already touched on the strategic alliance and partnership route. So as Darren says, it's often overlooked, and it can be a very, very good way of getting an idea off the ground, because you're not just getting the money, but you're getting, there are all the other potential synergies involved with finding a good partner that can help you turn the idea into a reality. So now I'll pass back to Darren, and then I'll be popping up again later on. Thanks.
I'll just sort of give you a little bit on what the funders are looking for, and some of the areas that may not be quite so obvious. I mean, a quality and commercial product in itself sounds obvious, but the big thing that gets missed is potentially monetisation, and how actually you can turn that product, we was talking about it actually before, how you can turn that product from being something that's user-friendly and attracts visitors to actually then making money. Now, the valuations in the marketplace for high-tech businesses at the moment have actually tended to reflect the potential to make money rather than actually how much money that business has made. How long that will go on for, we're not quite sure. But I see that monetize, and I see it creeping up more and more, that actually the ability to monetize a product is going to become more and more important. So that's something to think about and put in your business plans. Informed management is, look, funders are obviously looking for informed management. I guess one of the big areas, again, with tech startups, where it's often lacking is on a financial side. And I don't want to compare to Dragon's Den, but you've all seen it. You've all seen people with good business ideas get ripped apart because they don't understand the numbers, and we see that. It does happen. So even if you're not financial people, if you've got a good idea or your clients have good ideas, they need to understand the numbers, they need to understand the pipeline, they need to understand, most importantly, the cash flow. And either they need to do that themselves or they need to align themselves with people that do. A well-considered business plan and financial projections, I think is fairly obvious. The main thing I would add is that you need to look and address the key risks. There's no point hiding behind key risks and hoping people don't find them, because they will find them. Any of you that have raised funds for a new product will know they'll hit a snag that they probably knew was going to come up, and so no one's going to believe that there's no competitors out there for the product. There will be a competitor of some sort, whether it's a direct competitor or not. And it's how you address that and actually show that you've got a competitive advantage that beats that, I think, is important. The cash flow understanding, use of funds and plan for commercialisation is, I'm going to group these two together. I'd say there's two main reasons that new tech startups look to raise funds. One is development and two is commercialisation. And in my experience, I don't know if there's any angel investors in the room, but the one thing that annoys angel investors more than anything is when business owners come in, or new tech startup owners come in and say they want $500,000, and they say, well, what's it for? And they say marketing, and that's it. And that essentially what I'm saying is that funders want to know exactly where their money's going. They don't want to put £500,000 into a black hole called marketing. If it's going into marketing, that's fine, but you need to have a detailed marketing plan that sits behind it that shows exactly where that money's going. It's the same with commercialisation, really. People accept with new startups that they need development capital to get the product up and running, and that may be prior to actually commercialising the product and actually monetising it. But again, there needs to be a plan in place for doing that. People don't like to put money into projects with no plan of commercialisation. You know, is it going to launch to the market in 6 months, a year, 2 years? It needs to be predefined, and you need to know broadly how much you're going to need to get on to the next stage, because it's important when people are assessing the opportunity. Exit planning is always important. I think with tech startups, it actually sort of links into a plan of commercialisation, because for certain investors, certain VCs, they see commercialisation as their exit, because then the opportunity gets into the broad world, and there's actually then more opportunities for them to pass on their investment if they want to. You know, the classic exit plans are obviously IPO and a trade sale, but in high tech companies there are other options. I mean, you see new funding rounds happening all the time for high tech companies, well-known high tech companies, and so there are opportunities for investors to get out, but generally only at the commercialisation stage, which makes the plan for commercialisation that much more important. I thought it would be useful just to go through some specific issues just relating to the tech sector. I'm aware that there's an IP lawyer in the room, so I won't labour this point too much, but obviously with traditional businesses, lenders get their comfort through security on the business assets. Now, in a high-tech company, it's unlikely that you're going to have any assets, because the assets essentially is the IP, which makes the protection of the IP that much more important. And therefore, before you go to any funders, it's really important that you understand, or that you're clear that you own the IP and what protection you've got around competitors entering the market, because barrier to entry is really important. And it may be, as I've said before, it may be that there's no way to actually protect the IP from a legal perspective, and it may be that it's all first mover advantage, but you need to understand that and understand how you're going to combat that issue. Confidentiality, I think, links into the same point, but again, there's NDAs you can sign. There are ways of tightening up NDAs. So I would say on those 2 points, you need to get advice before you approach funders. The global market and therefore global funding opportunities, I thought was just quite interesting, because as part of my role, I also act as an interim FD for a software development company, and they're actually backed by a US VC. And I think tech's one of the few markets where actually you open up potential funders worldwide. Whereas if you're operating a UK manufacturing business that turns over £5 million, really you're looking at UK investors. Whereas you can be running a tech business that turns over nothing, and you can get interest from all over the world. So it's really interesting. So I think the funding opportunities are actually more global than for any other sector. Valuation I'll come back to in a minute, because it's a bit too big a point actually to just be stuck in the middle, but I'll come to that. Launch programme we've already discussed. It's important to have a plan for commercialisation. I'll just touch on a couple of tax issues that are specific to this sector. One is R&D. Again, I know there's an R&D tax specialist, so I won't labour the point, but there is relief available for R&D for tax companies, and it is at a higher percentage than any other relief. I think that's fair to say. So you need to get advice on that, because it can actually be a really good cash flow measure. And the second one I would talk about is EIS relief, and making sure that your company can attract EIS relief from your investors, because they can get 30% tax relief, providing you meet the criteria. And some of you may know there's actually a new EIS scheme coming in from the 6th of April, which is called Seed EIS relief, which is for smaller companies, so companies with net assets of less than 200,000, and actually the tax relief for that's 50%. So it may be that if you're planning to launch a funding programme around the end of March, you might just want to wait a week, and you've got more chance of attracting a pool of customers. Monetisation, I think we talked about. If we go back to just the valuation issue, those of you that have come in to learn how to value a high-tech business should probably go now, because unfortunately I don't have the answer, because I don't think there is one. essentially it's a meeting of minds. There'll always be there's never a bigger gap on the conversations we have than from an investor that wants to invest into a high-tech company and an owner that's trying to argue that their business is worth X, and the funder's saying, well, you haven't done anything and we're putting all the money into it's actually worth Y. Some things to think about would be, one thing we always advise our clients is to essentially get the products commercialised as much as possible, developed as much as possible. Business is worth much more, even if you haven't launched it to market, if it's a developed product, than merely a concept. So that's the first thing. Secondly, think about who you go to. Strategic partnerships are interesting because we tend to find that there's a sort of two-way battle on valuation, in the sense that they're arguing, well, our infrastructure is going to provide you with our infrastructure is going to provide you with a potential market for your product that can enhance sales, and therefore we want a high equity percentage. But if you can argue that actually your product's going to enhance their infrastructure, then there's a value to that. So there's sort of a counter argument, which I think is quite interesting. There are ways that you can get around the valuation issue. You can use ratchets, you can use forecasts, looking at future performance of the business, but it's really difficult. I mean, it tends to be for established or more established startups. If you take something like Twitter, their next funding round, they will dictate to the market what the valuation is, and the market will presumably go along with that, or there'll be a slight chip. Whereas for new startups, it's much more difficult, and it depends. It's all about attracting. It's the same as selling a company. It's about attracting as many funders as you can to get an auction process in place. Look, there's so many ways of dealing with valuation. I can't deal with them all here, and it's so company specific. So I'll hand back to Marcus to talk through the process.
Right. The process is the start of it is the strategy which Darren spoke about on the first slide, and then it's actually also been touched upon. Obviously, the importance of having a business plan and robust financial forecasts. Again, we've touched on that already. There's maybe just one thing to highlight there is the importance of the executive summary, because a lot of these people won't have time to read through these gloriously prepared business plans that a lot of people do that are about that thick. They might only read the exec summary. So creating a powerful exec summary is vital. And I'll just speed on through the others. I've just been given the sign. Identifying and approach suitable funders is the next thing. There's obviously loads of people specifically interested in tech. You want to know who's active and approach them. Then they would be sent an information memorandum. Some of them would display an interest that then be met, and you'd start to talk about possible terms, bringing to the next point, which is the negotiation of heads of terms. Each funder will have different criteria, and that's at a very vital stage where you need to make sure that your interests are protected and you get the best deal for yourself. Then they might do some due diligence on you. Because you're a startup, it's more likely to be commercial than financial. So you just be prepared for that and be prepared to tackle the various questions and things that they'll throw at you. Again, it's useful to have advice at that stage to prepare you for it. And then shareholders agreement, again, very sort of technical area. There's lots of sort of standard off the peg ones, but there are also some vital issues. I've written, I think we're running out of time, but I was going to go through a bit more there, but I'll leave it at that. It's just another key area that you've got to get right at the start. Otherwise it can cause all kinds of problems later on if there's a fallout between the people that are all mates to start with. It's vital that you get everything agreed at the outset. So I'll hand you back to Darren to close.
One final point I just wanted to make on the valuation I forgot to mention, which is a practical point, which is to make sure that when you're talking to your funder, make sure you're talking essentially the same language in terms of pre-money and post-money valuation, because it can make a massive difference. Essentially, pre-money value is the value of the business before they make their investment, and post-money is afterwards. And so if you take an investment, let's say you value your business at 10 million, they say, okay, fine, well, we'll take an investment of 10 million and we'll put £2.5 million in. Well, most business owners would think, okay, that's great, so I'm giving away 25% of the company. What the investor may think is actually you're giving away 33% of the company, because the actual valuation now is 7.5 million, and it will be 10 million once you've got my 2.5 million. And so we've seen disagreements on that in the past, and so just make sure you're talking the same language. You can catch me afterwards, but that's pretty much us.